This presentation is for Appendix 3A, a guide to earnings quality. The earnings statement encompasses a number of areas that provide management with opportunities for influencing the outcome of reported earnings in ways that may not best represent economic reality or the future operating potential of a firm. Some of these areas include accounting choices and estimates and judgments, changes in accounting methods and assumptions, discretionary expenditures, non-recurring transactions, non-operating gains and losses, and revenue and expense recognitions that do not match cash flow. Financial statement analysts should consider the qualitative as well as the quantitative components of earnings for an accounting period. The higher the quality of financial reporting, the more useful is the information for business decision making. In addition to earnings quality, the quality of information on the balance sheet and statement of cash flows is equally important. This is a checklist for earnings quality to help the analyst. Unfortunately, many firms violate the revenue recognition principles by recognizing revenue prematurely. There is a new revenue recognition principle that is based on contracts. The information on this slide is slightly out of date, but the new principle requires that all performance obligations are satisfied prior to the recognition of revenue, and that is similar to this slide, which states that delivery of products must have occurred and services rendered before revenue is recognized. Price must also be determined in the new revenue recognition principle. Collectability will not prevent revenue from being recognized, but if there is severe doubt as to whether the amounts will be collected, then there may not be a valid contract, and that would prevent revenue recognition. Revenue recognition policies will be in the notes to the financial statements, and the analyst can use this information to determine whether any changes have been made to the policy and the reasons for and impact of the changes on the financial statements. Analyzing the relationship among sales, accounts receivable, and inventory can signal red flags if these accounts are not moving in comparable patterns. Fourth quarter spikes in revenue may also indicate premature revenue recognition for companies that do not typically experience high seasonal fourth quarter sales. One example of premature revenue recognition is the use of build and hold techniques, where the company will recognize revenue on sales where goods have not been delivered. Diebold Inc. was charged with manipulating its earnings from at least 2002 through 2007 with this scheme. They also manipulated reserves and accruals, improperly delayed and capitalized expenses, and wrote up the value of inventory in an attempt to improve their earnings. Without admitting or denying the charges, Diebold Inc. agreed to pay $25 million to settle the SEC charges. Dell Inc. in 2007 admitted to financial statement manipulations that included premature revenue recognition. As a result, financial statements for the years 2003 through 2006 were restated. Senior executives and other employees overstated revenues to meet quarterly performance goals. As a reseller of other companies' software products, Dell should have deferred revenue recognition, but chose instead to record the revenue prematurely. The restatement in fiscal 2005 caused a reduction in revenue for software sales in the amount of $105 million. Another scheme used to inflate revenue is to keep the accounting books open longer than the end of the quarter. Computer associates used such a strategy prior to 2001, referred to as the 35-day month practice, to prematurely record $2.2 billion of revenue. Former Chief Executive Sanjay Kumar pleaded guilty to securities fraud charges and obstruction of justice and received a 12-year prison sentence and $8 million in fines as a result of this scheme. The allowance account, which is deducted from the balance sheet accounts receivable account, should reflect the volume of credit sales, the firm's past experience with customers, the customer base, the firm's credit policies, the firm's collection practices, economic conditions, and changes in any of these factors. Underestimating bad debt expense will boost net income. On the other hand, by overestimating the allowance account, firms can set themselves up for a later correction that will ultimately boost net income. By analyzing the allowance for doubtful accounts as illustrated in Chapter 2, an astute analyst can make an assessment about the likelihood of manipulation. There should be a consistent relationship, all other things being equal, between the rate of change in sales, accounts receivable, and the allowance for doubtful accounts. Companies should offer clear explanations if the amounts are changing at a different rate or in a different direction. The analyst should be alert to the potential for manipulation through the allowance account. Of course, there could be a plausible reason for such a change. This is an example of the allowance for doubtful accounts and accounts receivable for Seagate, Inc. for June 30th, 2006 and June 29th, 2007. There is a significant increase in the allowance for doubtful accounts, but sales have decreased. The explanation that was provided by Seagate in the notes was that they had terminated a major distributor, ECS, due to non-payment and failure to comply with the terms of its commercial agreements. They increased the allowance for doubtful accounts as a result. Seagate indicated that they would continue to pursue collection and record payments when received, as well as pursue any claims that were assertable against ECS. They had also commenced legal proceedings against both ECS and its chief executive officer. In a few cases, no information about the allowance account can be found at all in the Form 10-K. Logitech International SA offered no explanation for the volatility in charges to bad debt expense or write-offs of accounts receivable that could be observed in the company's 2010 Form 10-K. This is Logitech International SA's valuation and qualifying account schedule from Form 10-K, showing the charges to bad debts and write-offs for fiscal years 2008 through 2010. No explanation of the volatility in the amounts was provided in the notes. Procter & Gamble no longer includes information on its allowance account on balance sheet, in the notes, or in a valuation schedule. With over $5.3 billion in 2010 in accounts receivable, it seems unlikely that the firm has no bad debts. The quality of reported earnings is affected negatively by the lack of disclosure. If a company's sales are increasing or decreasing, it is important to determine whether the change is a result of price, volume, or a combination of both factors. Are sales growing because the firm is increasing prices or because more units are being sold? Information regarding the reasons for sales growth or decline is one of the areas covered in a firm's management discussion and analysis section of the annual or 10-K report as discussed in Chapter 1. To relate sales growth to reasons for sales growth, use sales data from the income statement and the volume price discussion from the management discussion and analysis section. A related issue is whether sales are growing in real, inflation-adjusted, as well as nominal, as reported terms. The change in sales in nominal terms can be readily calculated from the figures reported on the income statement. An adjustment of the reported sales figure with the Consumer Price Index or some other measure of general inflation will enable the analyst to make a comparison of the changes in real and nominal terms. This illustration shows the calculation of Ford Motor Company's nominal and real sales for 2012 and 2013 and the percentage change. Ford sales, when adjusted for general inflation, grew at a rate of 8.51%, which at nominal sales growth has kept pace with the general rate of inflation. Another way to see this is to note that nominal sales increased 10.11%, while the CPI increased only 1.48%. During periods of inflation, the last in, first out, or LIFO cost flow assumption for inventory accounting, described in Chapter 2, produces lower earnings than first in, first out, FIFO, or average cost. Just the reverse occurs if the firm operates in an industry with volatile or falling prices. LIFO results in the matching of current costs with current revenue and therefore produces higher quality earnings than either FIFO or average cost. The inventory accounting system used by the company is described in the notes to the financial statements that details accounting policies or the note discussing inventory. A base LIFO layer liquidation occurs with the use of LIFO in a situation in which the firm sells more goods than purchased during an accounting period. Base LIFO layer liquidations occur when companies are shrinking rather than increasing inventories. There is an actual reduction in inventory levels, but the earnings boost stems from the cost flow assumption that the older and lower price products are those being sold. The effect of LIFO reductions, which are disclosed in the notes to the financial statements, can be substantial. A base LIFO layer liquidation reduces the quality of earnings in the sense that there is an improvement in operating profit from what would generally be considered a negative occurrence, inventory reductions. In considering the future ongoing potential of the company, it would be appropriate to exclude from earnings the effect of LIFO liquidations because a firm would not want to continue benefiting from inventory shrinkages. The principle of conservatism in accounting requires that firms carry inventory in the accounting records at the lower of cost as determined by the cost flow assumption, such as LIFO, FIFO, or average cost, or market. If the value of inventory falls below its original cost, the inventory is written down to market value. Market generally is determined by the cost to replace or reproduce the inventory, but should not exceed the net realizable value, which is selling price less completion and disposal costs that the company could generate from selling the item. The amount of the write-down will affect comparability, thus quality of the profit margins from period to period. When the write-down of inventory is included in cost of goods sold, the gross profit margin is affected in the year of the write-down. Significant write-downs of inventory are relatively infrequent. Sometimes companies may write down the value of inventories every year in the 3-year reporting period. Analysts need to be aware of the impact of such write-downs when comparing the gross profit margins. A company can increase earnings by reducing variable operating expenses in a number of areas, such as repairs and maintenance of capital assets, research and development, and advertising and marketing. If such discretionary expenses are reduced primarily to benefit the current year's reported earnings, the long-run impact on the firm's operating profit may be detrimental and thus the quality lowered. The analyst should review the trends of these discretionary expenses and compare them with the firm's volume of activity and level of capital investment. Amounts of discretionary expenditures are disclosed in the financial statements and notes. Advertising expenses are usually detailed in the Summary of Significant Accounting Policies note. Most companies use the straight line method of depreciation rather than an accelerated method for reporting purposes because it produces a smoother earnings stream and higher earnings in the early years of the depreciation period. The straight line method, however, is lower in quality in most cases because it does not reflect the economic reality of product usefulness in that most machinery and equipment do not wear evenly over the depreciation period. There are additional issues that affect earnings quality with regard to the depreciation expense figures. Companies that misclassify operating expenses as capital expenditures have created poor quality of financial reporting not only on the income statement but on all financial statements. Recording an amount that should be deducted in its entirety in 1 year as a capital expenditure results in the expense being depreciated over several years. Another issue affecting the area of depreciation is that comparing companies is difficult when each firm chooses not only different depreciation methods but also different lives for their long-lived assets. The write-down of asset values following the principle of carrying assets at the lower of cost or market affects the comparability and thus the quality of financial data. The reasons for the write-downs would also be important in assessing the quality of the financial data. Information on asset write-downs is presented in notes to the financial statements. Firms also write down the carrying cost of property, plant, and equipment and intangible assets when there is a permanent impairment in value and when certain investments in marketable equity securities are carried at market value. The use of reserves is required for the allowance for doubtful accounts, product warranties, restructuring costs, sales returns and allowances, and environmental obligations. Analysts must determine that these operating expense reserves are not used to manipulate earnings. Accrual accounting requires companies to estimate and accrue obligations for items that must be paid in future periods but should be accrued in the current period. The creation and use of these reserve accounts is required to properly match revenues and expenses. However, the abuse of reserve accounts has been an ongoing issue. Cookie jar accounting, as the abuse is referred to, occurs when companies create or use reserve accounts for the purpose of setting aside funds in good years by over-reserving or reducing net income and then reducing charges or even reversing charges to the reserve accounts, increasing net income in poor years. The net effect is to smooth out earnings from year to year. Companies will often take enormous write-offs in one period, referred to as big bath charges, to clean up their balance sheets. In 2007, many banks took the big bath in order to write off losses in the values of securities held by banks. If banks have overestimated losses, they could report higher profits in the future if the securities values later rebound. In-process research and development charges are one-time charges taken at the time of an acquisition. The charged amounts are part of the acquisition price that the acquiring company determines are not yet viable research and development because they are still in process. These charges can be written off immediately under current accounting rules. Any revenue gains from the research in the future will cause higher earnings that have not been matched to the expenses that created them. Estimating the value of the research and development that is to be written off is difficult, and as a result, users of financial statements are unlikely to be able to determine whether these charges are appropriate. From a user's perspective, this is a problematic area because companies can write off significant amounts of research and development in the year of an acquisition in order to boost earnings in later years. When a company sells a capital asset, such as property or equipment, the gain or loss is included in net income for the period. The sale of a major asset is sometimes made to increase earnings and or to generate needed cash during a period when the firm is performing poorly. Such transactions are not part of the normal operations of the firm and should be excluded from net income when considering the future operating potential of the company. This table is from Goodyear Tire and Rubber Company's 2013 Form 10-K and shows the non-operating revenues and expenses that were included in Note 4, Other Expense. Typically, the gains and losses from asset sales would also be excluded, even if they are recurring items, because it would be impossible to predict the amounts of future gains and losses. Interest income is also non-operating in nature except for certain types of firms such as financial institutions. Interest income results primarily from short-term temporary investments in marketable securities to earn a return on cash not immediately needed in the business. In the assessment of earnings quality, the analyst should be alert to the materiality and variability in the amount of interest income because it is not part of operating income. Interest income is disclosed on the face of the income statement or in notes to the financial statements. Use of the equity method to account for investments in unconsolidated subsidiaries permits the investor to recognize as investment income the investor's percentage ownership share in the investee's reported income rather than recognizing income only to the extent of cash dividends actually received. The provision for income tax expense on the income statement differs from the tax actually paid. When assessing the net earnings number, it is important to differentiate between increases and decreases in net earnings caused by tax events. A significant change in the effective tax rate may be a one-time non-recurring item. Included in the income tax notes to the financial statements is a reconciliation of the U.S. federal statutory tax rate to the company's effective tax rate. By reinvesting overseas earnings abroad, U.S. tax law allows firms to avoid paying at the higher U.S. tax rates. Should the firm repatriate the earnings back to the United States, the dollars would be taxed at U.S. rates. When projecting future earnings, the analyst must consider whether the firm will need to repatriate funds in the future, causing higher taxes in that year. In addition, it is important to stay abreast of changes in the tax law that would eliminate the current benefits of leaving earnings overseas. Discontinued operations should be excluded in considering future earnings. Two items are recorded if the discontinued operations have been sold: the gain or loss from operations of the division up to the time of sale, and the gain or loss as a result of the sale, both net of tax. This schedule from the footnote disclosure in the 2013 Form 10-K for Zebra Technology shows discontinued operations. It would be appropriate to deduct the net earnings on discontinued operations in all 3 years from net earnings for comparative purposes. Extraordinary items are gains and losses that are both unusual and infrequent in nature. They are shown separately net of tax on the income statement. Because very few transactions meet the definition of extraordinary, it is rare to see such items on an earnings statement. The gain or loss should be eliminated from earnings when evaluating a firm's future earnings potential. The number of common stock shares outstanding and thus the computation of earnings per share can change materially from one accounting period to the next. These changes result from such transactions as treasury stock purchases and the purchase and retirement of a firm's own common stock. The reasons for the repurchase of common stock should be determined if possible. Some firms use repurchase programs to obtain shares of stock to be used in employee stock option programs. Other firms offer no reasons for their repurchase program. It is important to consider whether a firm is spending scarce resources to merely increase earnings per share. The effects of reducing outstanding shares of common stock result in an increase to earnings per share. Operating earnings or profit is an important figure for assessing the ongoing potential of a firm. Some companies have created their own operating profit numbers and tried to convince users that those figures are the ones to focus on instead of the GAAP-based amounts. These company-created numbers go by a variety of names such as core earnings, pro forma earnings, or EBITDA. EBITDA, for example, refers to operating earnings before interest, tax, depreciation, and amortization expenses are deducted. The SEC adopted a new rule in January 2003 that requires companies reporting pro forma financial information to present this information in a manner that is not misleading and also reconcile that pro forma financial information with GAAP. Each individual user of financial statements should adjust the earnings figure to reflect what that particular user believes is relevant to the decision at hand. Based on that checklist, Exhibit EA2 in the textbook shows the items that should be considered as adjustments to earnings. This is the checklist that can be used to adjust earnings for comparison purposes and for projections into the future. This is the end of the presentation for the appendix for Chapter 3.